Well, everybody. Welcome to another installment of our Southern California housing market update. My name is Stephen Meade here with Domicile real estate for people who love houses. It is January 11th. We are getting past that holiday zone. We're also getting to the point where new inventory starts coming on the market. So we have a lot of sort of market forces happening. And then we kind of had a little bit of a curveball thrown at us this week, and that was interest rates moving up in sort of a noticeable fashion. Before we jump into the slides, one of the things that I've always talked about is really there's two components when we're talking about interest rates going upward. The first component is how far up they go, but the second component is how fast do they go up. And really, speed isn't measured so much by how fast they go up in one day, but really over a period of a month, how fast do they move. So just kind of bear that in mind as we're talking about some of these things and how it might affect the market. So we're going to go ahead and launch into it. I'm kind of excited. We've got some things going on. Does this mean there's a reprieve for buyers? Maybe. We're just going to have to see here. All right. So total active listings. Let's talk about where we are in the market. As predicted, we are seeing inventory bounce off of those lows, and we're seeing that both under $1 million and in our $1 to $2 million category. However, I think it's really important, to take this look back here and kind of see where are we at. That inventory level is still way below where it was at this point last year. So understand we are still very much working from behind. So this is encouraging news. This is a sign that the market is reacting as we might expect it to. However, our overall level of total active listings is still considerably lower than it was at the same point in time last year. If we look at our 14-day new listings, right, this is always kind of a fun chart for me because I think if you drew a straight line here, you'd see that we ended up right where we thought. And what happens is this: you have this Christmas time period and this New Year's time period, right, where you don't have a lot of listings. Those listings don't disappear, rather, they're just delayed. And here they have come back, and we're right about where we might expect to be at this point in time. So kind of a little bit of a rebound. We're still not anywhere near our normal springtime, and we are still, a little bit less than we would normally expect for this time of year. And I'm going to go off share here for a second. One of the things that we're hearing out in the marketplace anecdotally, I think you ask yourself why are we not seeing the new listings show up? It's not like there are fewer houses in Southern California that could come up for sale, but why are fewer hitting the market? And one of the big things that we're hearing is there are a lot of sellers that want to move up, but they are, they're looking at it from the perspective, like most sellers who are moving up, they're thinking about where they're going, right? So when they're thinking about where they're going, all they're seeing is crazy market, offers don't get accepted, things go way over list price. And what they're not doing is looking back and understanding they're also going to make a ton of money, right, on their current house. So, they're not always seeing both sides of that coin. So one of the struggles that we often face is kind of giving sellers that amount of confidence that they are going to be able to find something. We are going to be able to work the sale so that they can sell their old house and buy the new one and have a fairly smooth transition, or as smooth as possible. So we're really seeing that kind of psychological factor is limiting the new listings hitting the market. I think that's a very big component. Now, let's look at what's happened, though, with new escrows, though. The new escrow number has not rebounded. And I'll be honest, I do think that that's a little concerning. With that said, sometimes remember that putting a house on the market is easy. It takes one day to do that if you've got the photos already. But buying and negotiating on a house takes time once that listing hits the market. So sometimes there is a little bit of a delay where we see, the listings go on the market, but it takes a week for those to be absorbed by buyers and for these new escrow numbers to kind of shoot up. So definitely kind of watch this space a little bit because we're going to kind of want to see where we end up with that. If this stays flat, right, that'll mean that the interest rates rising is having a big effect on that market demand. Now, here's our absorption rate, right? And this is the second week of kind of really very remarkably low numbers. You will notice we had a similar dip last year at the same time. So this isn't entirely unprecedented. It's a dip to about the same level. I really want to see what happens in your next week, because that will be a week, meaning that we don't have any effects of the holidays. We'll be past the 14th of the month. So we won't have any holiday sort of issues affecting those numbers to get kind of a better bearing. I mean, if you look here, you see these wild gyrations in absorption rate. That's an artifact in the data due to the holiday weekends, or this year was holiday weekends, but the Christmas and New Year's holidays. If you look here at closed prices, and again, this is a look back of what was the market 4 to 6 weeks ago, we actually see really appreciable gains in this, in both the median, which is kind of that 750 to a million range, and that entry level 25th percentile, which is kind of that 600 to maybe 750 range. Pretty flat on the high end. I think we might see some compression in prices, meaning we might actually see those entry level prices gain a little bit faster than the high level. That's a little bit of a prediction that I have for the spring. Now, if we look at our percent still active after 14 days in the market, this actually leads me to believe that buyers are starting to come back into the picture. And the reason why I think that is true is because in the last period of 7 days, we've just had a huge influx of listings, and this number is tempered. It's not shooting up as much as we might expect it to, meaning that those homes that are just hitting the market are starting to get absorbed up. We're going to have to wait until next week to see that. Finally, kind of looking at this list close or close to list ratio, I've often described this as the discrepancy between where sellers think the market is and where buyers feel like the market is. And whenever you see it over 100%, it means the buyers feel that the market is a lot more competitive than sellers do. And if you look, this is really a stark change from last year, where we're actually almost down to right at list price, which is still a very strong market. But here, we never really dropped. We never got down to that point. On average, these $1 to $2 million homes are still closing for, on average, almost 104% of list price. That is really quite remarkable. I am very curious to see if some of these interest rate changes end up affecting that in the marketplace, whether that starts to bring this back down towards, more of a normal market. Technically, a normal market is around 98, 99% close to list ratio for us here in Southern California. We haven't seen a normal market in years. So, I wouldn't hold my breath for that to happen, but I'd like to get well into this 100 to 102 range, where there's a little bit closer of a matching of those market perceptions. Now, this is kind of like a little bit of a fascinating one for me. Historically, higher priced homes take longer to sell. So this is days on market for the new homes going under contract. We see a continued rise. And in fact, we're actually finally seeing this number for our under 1 million is matching about where we were last year. Now, the real question is this going to do a 180? Is it going to start heading back down again as we go into the spring time period? And that I'm really not sure about. We're going to have to see where that settles out. But you look, our luxury market has in fact done that 180 with dropping days on marketing. It is nowhere near where it was at this point last year. Our affordability statistic, you'll notice that really since over the spring and summer, this has crept up fairly slowly. We're still under 120%. I think we're kind of in that 118, 119%. And just as a reminder, this is showing us where is the payment on a median priced home compared to June of 2018. So over 3.5 years ago, almost 4 years ago, how much has the payment gone up on a median priced home? And honestly, I don't think 118% is an unreasonable number. So even combining these rising interest rates, we're still not in a kind of a crazy town zone at the current prices. But this really is the chart that I think kind of tells you something, right? Is, this is a pretty moderate slope. And the question is this a temporary step rise that we've seen? Is this going to turn over and curl down? Or are we making a run for 3.5%, 4% on interest rates? And how fast is that run going to happen? One of the things that's fascinating to me in this market is understanding both the primary and the secondary results of rising interest rates. And I want to take a second on this because I think this is really important for people to understand. So obviously, what's the primary effect of interest rates going up, right? The primary effect is people are less likely to buy a house. I think that this might even affect, when you think about what groups are affected most by this, I think the luxury market, those buyers tend to be smart. They can oftentimes wait. They don't need to buy a house. And if they see the rates going up, they might say, I want to wait until later. I don't think that's going to happen. I think most of those buyers are going to look at this and say, these are still really low overall. We are in the threes. That's still very good for the long term. And in rising inflation, they are going to be okay with that. I don't think that's going to really dissuade that luxury market. At the entry level, it's kind of a mixed bag. And here's my reasoning. I think entry-level home buyers have much more motivation to buy in general, right? I think they look at themselves being on this rent treadmill that is never ending, and they might be willing to say, I don't care that rates went up a little bit. I want to stop that treadmill now. As soon as there's more inventory and I'm finding houses I like and that I can afford, I'm going to buy something. But also understand from an affordability standpoint, that entry-level group is more affected by rates. It's not a whether they want to buy a house, it's whether they are able to buy a house. And I think that is adversely affected. So those are our primary consequences of rising interest rates. But really, there's a secondary consequence. And the big secondary consequence is where do entry-level homes come from, right? Entry-level homes primarily come from people who are moving up to a larger house. So those entry-level buyers might be moving to a mid-level home, right? Meaning their home is now worth $700,000 or $800,000, and they might be moving to right around $1 million. My fear is that that buyer group is going to be disproportionately affected by higher interest rates. And if that happens, that means that supply of new listings, especially at the entry-level end of the market, is going to reduce. And if that should happen, what it does is it means even if buyer demand drops, it will not result in prices dropping in any kind of precipitous manner. And the reason being is because we will have less supply. So we will still have an equilibrium point on that supply demand curve that's they'll still cross at the same point price-wise. There will just be lower volume, meaning fewer homes will change hands at that entry level. Fewer sellers will be putting them on the market and fewer buyers will be buying, but the prices will be largely unchanged. The unfortunate part, of course, is that this means families looking to get a larger home won't be doing so. They'll be living with that home that isn't necessarily working for their needs. And entry-level buyers will find they have even less selection, and their payment for the same house will be higher than it was a year ago. So kind of some interesting stuff. We've got an idea for a video. Write in the comments if you think we should make this. We're calling it the consequence of being wrong. Meaning if you are a buyer in the present marketplace and you're trying to guess what is going to happen, we'll explore both scenarios, a stable market, a declining market, and we'll see what happens if you're wrong and the market does the opposite of what you are predicting. What are the consequences of being wrong about that, and how might that affect you? So if you want to see that, definitely write to us in the comments. Say you want to see the cool video, and we will put that together. We're going to have to do some more graphics and some more other stuff, kind of up the editing and production value a little bit to make that happen. So really give us some encouragement, and we can get that done in the next week or so for you. Anyhow, thank you so much for watching. Don't forget to like, subscribe, hit that notification bell. And as always, if you are looking to buy or sell real estate in Southern California, we would love to lend you our expertise. Also, if you have questions, don't hesitate to ask. We love questions, and we will hear again from you and talk to you again real soon. Happy Tuesday, everybody.